Like that would be my most probable path is this, and all I care about after that is does a higher low form. If it does, then I would say bottoms in, and it's just like 2020 or any of these other times where you go back, you look at the market in here, right? You had your flush out, you had your run up, everyone got excited, back down, but it made a higher low. Pushed up again, made a new high, came back, made a higher low. To me, that's all that really matters. Flush out. Low, higher low. Higher high, higher low. New highs, and away we go. Price predictions, targets, all that, doesn't really matter to me. That's why we stay predominantly spot long. For my long trade, I did start adding again, but I'll talk about that in trade of the day. Now, today we have the QRA, which I talked about yesterday on Weekly Outlook, so you can check Weekly Outlook for that. But here's a good post by a guy called Miad talking about the importance of QRA. Today we'll get an idea of how much Treasury will likely borrow for the coming quarter. On Wednesday, we'll know the exact composition, i.e. more bills or more bonds. So today, we're going to find out the rough guideline. Wednesday, we're going to find out what instruments they're going to do that through. And also on Wednesday, we've got the Federal Funds Rate decision, the FOMC meeting, and Powell's speech. So big week of the whole macro liquidity shit. But he's saying either way, massive moves for gold coming, because gold is extremely sensitive to all these changes. And as we know, gold and Bitcoin are very tightly correlated at the moment. So, if bond issuance increases and real yields move north, expect a scenario where gold will essentially nuke. That's important. That's one potential outcome. So, brush up on what this means and look out for it today and Wednesday. On the other hand, if real yields move lower again, gold will go for 2100. Simple as that, we have a breakout. And it is really that simple. Gold and Bitcoin, as an extension, are waiting on this. The reason for that is because real yields especially, real yields are the actual return you can get on your cash. Right? Gold and Bitcoin are not yield-bearing assets. They don't produce any returns. They don't produce, any dividend. They don't produce any yield. The returns you get on gold and Bitcoin are just from price appreciation. So, with Treasury and Fed actions, you can get changes in what the real yield is, which is the interest rate less inflation. And if interest rates are 5.5%, and inflation is 3%, you get a positive real yield. There's also other ways you can estimate. Many people estimate yields in different ways. Some people use GDP as well. You can include GDP because if GDP is whatever, like say, if interest rates are 5%, GDP is 5% or 6% in a year, you have to also factor that in because you have to overcome the 5% you could get from the Fed and the 5% productive output from the economy. If the GDP, in a really simple sense, if the GDP of the US is growing 5% a year, that means you need to make more than 5% a year just to keep up. Because GDP is the gross domestic product. That's the total output of the US economy. If that's up 5%, you can be absolutely certain that the stock market will be up at least 5%. Because the stock market is all the biggest companies. And so if GDP is 5%, the stocks are going to be up. Those companies are going to make at least that, if not more, because they're the ones producing the majority of the output. Plus, you then have all the debt issuance and the fucking fiscal spending and all of that juices the GDP even further. All that means is you have to get higher returns in order to just run at par. Whereas if those levels drop, and if we see a drop-off in especially the real yields, it makes gold and Bitcoin more attractive because cash is less attractive. If you had, let's say the Fed cut the rates to 4% and inflation was staying at 3%, you would only have a 1% real yield. You only have 1% returns. Because you get 4% for giving your dollars, putting your dollars in money market fund. But 3% of that's wiped out inflation. And so then investors say, is it really worth putting my money into an MMF just for 1%? It's not. That's where they then go and look for other speculative or defensive or whatever types of assets, including gold. And gold's very sensitive to monetary policy, as is Bitcoin, and fiscal policy. So the more printing, the more liquidity injection from not just the Fed and the US Treasury, but all central banks and all governments has a big impact. So gold is currently, like he says in his Twitter thread, gold is definitely at this inflection point where it can go down very easily and it can go up and break out very easily. Whichever path it takes, you're going to see a super strong effect on BTC as a result. There's an inside month forming, so you know an inside candle between December's high and December's low, and then when you zoom in, you can see that within this we've got January's low and January's high, the dotted red lines, and I've got the indicators or the alerts set on each of them. Whichever way this breaks will be very interesting. The most important break is December's low and December's high, but also January's low and January's high will be important as well, because we're only 2 days away from the end of the month, right? We've got today, tomorrow, and Wednesday. So just under 3 days, between 2-3 days left. That's going to be a big one. And if basically, in a very simple sense, gold up, Bitcoin up. Gold down, Bitcoin down. All else being equal, that's how it'll go, right? It's not exactly, obviously, the gold chart doesn't look exactly like the Bitcoin chart, but you can be sure that that's going to be the best case and the way it'll look. Because what happened to gold from October all the way into December? Big rally. What did Bitcoin do? Big rally. Oh, it was the ETF. Was it? Was it the ETF? Or was it the ETF plus the fact that positive gold flows and positive gold appreciation helped BTC to rise? It's both, right? The whole world, the whole macro is just one big trade. It's all one interrelated organism. So you got gold. You've also got silver, which is just, I mean, if this breaks to the upside, it's fucking insane. Because silver has been, if you actually go to a quarterly chart, so it's a 3-month chart, silver peaked out in 2011, all the way down into 2015 and a double bottom of 2020 and COVID. Broke out from that level, up into the highs 2021, back down, so flipped that, so resistance into support, held it. So that's a 3-month basis. Flipped down to a monthly with this diagonal trend line breakout. I think I actually have that marked on a weekly. Where do I have it marked? Maybe it was on the... Anyway, even regardless of how you draw it, it's just a trend line. But you can see clearly it's broken out of it, consolidating outside of it. Silver will follow gold broadly. They're not the exact same, but they are obviously historically pretty well correlated. And if we see this positive, trade for anything that is not fiat, so it's an anti-fiat trade, which includes gold, silver, Bitcoin, you'll see price move up, and that will also be a positive for crypto market. So these are going to be sensitive to what happens this week. Stock market as well will of course be sensitive to what happens this week, because Yellen's going to tell you what she's doing with debt this year. Then Powell's going to indicate what they're doing with monetary policy this year. Yellen's going to say, how are we going to fund our massive fiscal deficits? How are we going to pay our fucking $34 trillion debt? And so I think with stocks, to me, the most likely outcome is probably more upside first, and then a pretty decent pullback. So like probably another maybe month or two of upside, and then a pullback into this area, and then probably a reacceleration to highs. And then if things get bad, which I think will be next year, personally, I could see us coming down and attacking these lows, and then continuing the march that stocks do, just up only. I do think this level can get tagged at some point, but I don't think it's before we go higher, and before we form a higher low, because look, it's low, high, higher low, higher high, higher low. We'll form a higher high, we'll probably form a higher low, because the next big dip will get bought. This is the thing. I think a lot of people are really mid-curving this. The doomers are always going to be doomers. The stock market is fucking bullish. Wealthy people, their portfolios are all-time highs. The outlook is strong. People are saying that the debt's unsustainable. The earnings don't match. The price to earnings ratios are crazy. The valuations in the stock market are insane. No. The more they debase the currency, the more the stock market will go up. It's simple. The more liquidity, the more money they flow in, the more stocks will go up. This happens especially so the worse the currency gets. So the more dollars they print, the worse this will get, and the better it will be for stocks. But it's not better, right? Because when you actually divide the S&P by the money supply, USM2, it's not even keeping pace. So when you look at it just raw, it looks great. When you look at it like this, it doesn't look so great, does it? This is when you account for the money printing. So the amount of money they actually printed since 2000 net has way outstripped the actual price of the S&P. So if you bought the S&P in 2000, you're not actually even back at relative highs yet. But by owning the stock market, you have outperformed the average person. So your purchasing power has been preserved in that sense. The average person who doesn't own stocks, and they were making $2,000 a month in 2000, they're probably making $2,500 a month now. But every consumable, every travel, goods, everything is like 3 times as much since 2000. A fucking McDonald's hamburger, I saw this, and maybe you burgers can confirm. A McDonald's hamburger in the US is basically $3, I think. Just a hamburger. That was always $1 when I was a kid. That was always $1 20 years ago, right? And like that's real inflation. Like, because a McDonald's hamburger, that's what every person eats, right? Not every person, it's up to your own choices, but you know what I mean. It's not like a luxury good. That's a fucking everyday consumable for many people. So since 2000, let's say, has your salary increased 3 times? Most people's hasn't. But the cost of a fucking burger has. Like, that's the reality. So people saying the stock market's overbought, it's not. Look at this. It's just not. It's not. It's fucking not. And you can see that with plenty of room to the upside, people will look at these charts and, put it on a monthly and look at it like this, and it looks scary, right? Oh, look, it's going to crash. Like, what do you mean it's going to crash? Log chart. Long-term chart should be on log. There's the log chart. Right? Not crazy. Just rising. Because it should rise. Because GDP keeps rising. The economy keeps expanding. We've been in a pretty much uninterrupted expansion since 2009. And that will end at some point. But it's a decision by the policymakers to let it happen. And they haven't made any indication that that's going to happen yet. So, today, Yellen. Wednesday, Powell. Gold up, Bitcoin good. Gold down, Bitcoin bad. And then, like this thread says, real yields moving lower is what we want to see as bulls. Bond issuance increase. An increase in real yields. Not what we want to see. So we'll see that coming in. Alright? GM, see you later on the live stream.